Welcome everyone to our quarterly webinar. I'm John Longo, Beacon's CIO. As you can see if you're looking at the screen, our title is 2018 Q3 Review and Market Outlook. The stocks surge but shake in early October. And the surge is almost a distant memory as we filmed or recorded this in late October because a lot of the market's gains have evaporated. I'll elaborate on that excuse me, as we discuss the presentation. Here's our roadmap as usual. We'll talk about what happened last quarter, Q3. We'll talk about some winners and losers, or outperformers and underperformers. Happily, last quarter, there weren't too many losers, at least in absolute value. Importantly, we'll talk about the current macroeconomic outlook. That will dovetail into our views on the stock and bond market. We'll talk about our portfolio changes, or actually lack thereof. And as usual, we'll wind up with our discussion of our target portfolios. So let's get started. Well, it was a very good quarter for stocks last quarter. As you can see if you're looking at the screen, from June through the end of September, it was largely up with some volatility, but as October rolled around, it was hit by a confluence of factors, and the 10% gain that we had roughly at the end of Q3 has been cut roughly by 2/3. So we're still in positive territory as I'm doing this recording, but it's a pretty volatile time for the market. But going back to Q3, stocks had a very healthy 7.7% total return increase. And that was backed by a number of things, mostly strong profits. That was probably the most popular or most important thing driving it. We'll talk about GDP in a moment. Well, bonds had a much more muted quarter. The 10-year Treasury, which is the benchmark, moved up from 2.8 to 3%. That kind of flattened returns. And as the quarter ended, interest rates continued to move up, which I think is one of the reasons for the decline in equity. And year-to-date, bonds are actually down about 2%. Okay, so in terms of the 10-year benchmark, it peaked at around 3.25% in early October. And as of this recording, in mid to late October, rates are down slightly, around 3.1%. But overall, the direction of interest rates is up. So looking at some well-known market indexes, most investments in Q3 were up. U.S. equities led the pack. International equity lagged a little bit. Bond returns were flat, even though they're down year-to-date. They were flat last quarter. And real estate did deliver modest gains. So some specific numbers. As I mentioned a moment ago, S&P up 7.7% in Q3. Growth did a little bit better than value. So the Russell 1000 growth was up a little more than 9%, while value was up about 5.7%. International stocks, not quite as good. MSCI World is one well-known benchmark. That was up 1.3%. While emerging markets fell a little bit. So emerging markets have been among the losing investments this year. The Barclays Aggregate Bond Index edged up a shade more than zero. Munis went down a little bit, so kind of a flattish environment for bonds. Small caps up a little bit, not quite as large cap, 3.58% for the Russell 2000. And last but not least, in terms of our benchmarks, REITs went up 1%, better than the bond market, but lagging stocks. So overall, a good quarter for most asset classes in Q3. It's not shaping up that way for Q4, but there's still a lot of time left. In terms of our top 5 outperformers, at least on our open architecture platform, well, anything that was index related did quite well. So the Vanguard Total Stock Market Fund was up 7%, pretty much in line with the market because it is a market index fund. Our in-house Beacon Accelerated Return Fund increased a healthy 6.4%. The Vanguard Equity Index Fund, that was more of a value-oriented fund, at a pretty decent 5.3% rate of return. Our small cap offering, the S&P Small Cap ETF, was up 4.8%. That outpaced the Russell Index, which consists of 2,000 names. So this one's more focused a little bit on higher quality issues within the small cap universe. And another internal strategy, Beacon Plan Return, was up 3.5%. For those that are involved in that strategy, you know that it has some downside protection as well, which fortunately is needed in October. So it should be at least a relative outperformer in this month. In terms of underperformers, fortunately not too many losses. Oakmark has been a sore spot this year, despite stellar long-term performance. Oakmark, if you're not familiar with that fund, is a value-oriented fund. They own a lot of European equities that have lagged year to date, but they do have one of the best long-run track records in the business. So we're going to give them a little bit more time, and we follow up with them twice a year just to make sure we have confidence in their methodology and so forth. And so far, I'd say we still have confidence. Versus Capital Real Asset Fund is one of the newer additions to our platform. That's broadly defined as an infrastructure fund. That was flattish. And then on the fixed income side, we have the Fidelity Muni Income Fund that was up a little bit. BlackRock Strategic Income Fund actually outpaced most bond indexes, up 0.37%. So we'll take that in a quarter where the main fixed income index, the Barclays Agg, is flat. And then another Versus product, their real estate product, was up a decent 1.37%. That outpaces the REIT index, as well as most income-oriented investments. So fortunately, not too many losers in Q3, and those that lost were down fairly nominal. Now let's shift gears and talk about the macroeconomic landscape. And despite a lot of the rumblings in the market, I think the economic landscape is good. So we can talk about what's driving the market down. There's some trade tension with China. There's a tragedy unfolding in Saudi Arabia with the murdered journalist and the fallout related from that. There's continued trade tensions. There's Russia and the U.S. Perhaps pulling out of an INF nuclear treaty. And Italy is also causing some rumblings. Their budget is resulting in a larger deficit according to the EU rules, and that's creating some tension in the Eurozone. But looking ahead, LEI stands for Leading Economic Indicators, and it's basically a basket of 10 indicators, things like average hours worked, inventory, as well as things like the S&P index. And what you can see if you're looking at the screen is that it has a pretty good track record of going down in advance of recessions. And recessions are represented in the graph by these gray shaded areas. So pretty much every recession, LEI goes down. And what you can see here over the last 12 months, especially with the inset, it's gone straight up. And the last data point, it went up a value of 0.5%. You might say, what does that mean? Well, that ranks in the 84th percentile of most strong expansions. So we don't see the economy going off the cliff anytime soon. We're going to see as the data unfolds months ahead, if the geopolitical turmoil does bleed into the economic indicators. But most of the indicators I'm going to show you are pretty solid, and that should be positive for profit growth going ahead. Another forward-looking indicator is ISM. That stands for Institute for Supply Chain Management. And they do a survey of buyers, and they do two surveys. On this graph, we see the manufacturing index. Manufacturing could include a lot of things. It could include automobiles, defense, energy. And how you interpret the numbers, if it's greater than 50, it signifies expansion. Less than 50, there's a risk of contraction. And what we can see here is the number's pretty healthy. We can see a number almost 60, a little bit down from the prior value, but we'll take that. Anything over mid-50s is very solid. So that's manufacturing. Moving on to services or non-manufacturing. Services, of course, includes financial services, education, healthcare, things of that nature. Same thing, a survey of purchasing managers or buyers in that area. And anything greater than 50 signifies expansion. We see a very healthy number here, around 61.5 to 62. So good news in the service sector, at least according to this indicator. Another thing that could lead to a recession is a so-called credit crunch. So one thing I keep an eye on, what's happening to bank loans. Are they cutting back on loans? And the answer is no. Despite the little bit of a slowdown we've seen in the real estate market, bank loans continue to expand. And in percentage terms, this is around 3 or 4%, which is in line with GDP. So no signs of a credit crunch, at least currently in mid to late October. Now, another thing that could derail the economy is inflation. And so far, inflation seems to be under control. The number is less than 3% on a year-over-year basis. And two things typically drive that. One is wage inflation, and the other on the next slide is an increase in commodity prices. So we can see here is a little bit of an uptick in wage inflation, but it's still below the 3.5% to 4% range, where then you get concerned about inflation taking off. So I would describe wages as going up, but nothing too crazy. As I mentioned, commodities are another thing. As I'm doing this, oil has actually gone down to around $68 a barrel, down from 75 to 80 just about a month ago. So commodities are, increasing modestly. If you look at this index overall, a basket of all indexes has actually decreased 6.8%, at least on a total return 5-year basis. So I would just describe commodities as kind of flattish, maybe increasing slightly, and nothing to be terribly concerned about in terms of setting off, rampant inflation. The unemployment rate is the lowest it's been in 49 years. That's a very strong number. If you're wondering what might be a long-term or a near-term bottom, I'd probably say around 3.5%. There have been lower numbers in the post-World War boom, where the lowest rate on record was 2.5% in May of 1953. I doubt we're going to get down to those levels. I'd be happy to be pleasantly wrong there. But it is a positive. When people are employed, they spend more. And that, as you know, the consumer is about 2/3 to 70% of the economy. So having a good job is good for the person, but it's also good for the economy. And this is just another sign of the robust strength of the U.S. economy. It generally does not fall off the cliff and jump from 3.7% unemployment to 5 or 6% overnight. So to summarize our economic outlook, the economy is in pretty good shape, very good, I would say, with unemployment at its lowest level in 49 years. The Q2 GDP was officially confirmed at 4.2%. The Q3 number is coming out momentarily. That number ranges anywhere from 3.4% with the consensus number to 4.4% with the Atlanta Fed. So anything above 3%, I'd say, is pretty good. If you look at other things like the leading indicators I alluded to, as well as real estate prices, things are good to solid. Moving on to the second of what I'll call our big three. The big three would be the economy, the stock market, and then the bond market. Let's talk about equities. Well, as I mentioned, equities were up close to 10% at the end of September, and the vast majority of that gain has evaporated as of mid to late October. It's still in positive territory. Now, fortunately, and one thing giving us the conviction to stay the course and not make a radical move and go to all cash, is that valuations are reasonable. They're not cheap, but they're not crazy expensive like they were at the internet bubble. So if you're looking at the graph, we see one measure of valuation, forward PE. PE stands for price to earnings ratio. So if a company is valued at $1 billion and has earnings of 100 million, that would be a PE of 10. You can see over the past 25 years, that number is average around 16. And currently, we're around 16.8 with the pullback that we've had since the beginning of October. We're still back in that 16 area. So I would describe stocks as reasonably valued, not cheap like they were in 2009, but not crazy expensive like they were in the period near the internet bubble. But the valuation of 16 or so for the overall market doesn't mean that every single stock has a PE of 16. And what you can see here, if you're looking at the graph, is those that are in green are selling at low PEs. So you can see, for example, there's a lot of value in financial stocks, some in the phone companies, the auto companies, if you believe that those companies aren't going to fall apart. There's some expensive stocks in the so-called FANG companies, Facebook, Amazon, Netflix, Google. We see Visa, MasterCard, and PayPal also. So generally, those industries or firms that are growing quickly are given a higher valuation. So my point in showing you this is that even though the market may be fairly valued, there are some pockets of undervaluation if you look closely. Importantly, we're concerned about the threat of a new bear market. And I know there's a lot going on this table, but the takeaway from the table is that in almost every instance, a bear market has been set off by a recession. And there were a couple of other bear markets. We had the crash of '87 that was a crash of losing more than 20% in a single day, and the market eventually recovered the bulk of those losses. There was a crash in 1962 with the Cuban Missile Crisis, but that recovered fairly quickly as well. So in almost every other case, the bear market has been set off by a recession. And as I showed in the economic indicator section, we don't see any near-term sign of recession for the next several months at least. Most economists are worried about 2020, 2021. And as I said, if we're growing the economy at 3 to 4%, you don't fall off the cliff overnight. You typically decelerate and then maybe eventually go negative. So fortunately, we don't see the traditional signs of bear market here yet, and that's another reason we're generally staying the course with client portfolios. But as I alluded to in our call last time, if you dialed in, we are now officially in the longest bull market on record since 1900 when we have pretty good data. In terms of duration, it's the longest. In terms of a rise from the bottom, we're still lagging the one prior to the internet bubble in the 1990s, and we're still a solid 50% or so behind that number. So I doubt we get there, but let's hope to be surprised again on that. So in terms of our market outlook, well, we think that from here, stock gains are going to be proportional to earnings growth. And you can look at various models, but most consensus estimates are predicting earnings to go up anywhere from 8 to 10% over the next 12 months. So that's our outlook for stocks, that you're probably going to get high single digits, hopefully low double digits, and you're not going to get much expansion in the PE multiple, but you will get those earnings driven by a number of things. The tax cuts are still in effect. Companies have been investing in capital expenditures, and there's still a very solid economy. The consumer spending, especially with unemployment at 3.7%. But I would not describe us as super or crazy bullish because the valuations are not cheap. We know that interest rates are going up. That typically puts a damper a little bit on equity prices. And I'll allude to the risk, but we see the risk of a trade war as well as some other geopolitical risks that have some concern. In terms of where we see value within equities, well, even though they're now lagging year to date, we think that there may be some more value in small cap and international equity as opposed to these large mega cap U.S. equities, led by the so-called FANG stocks. What would change our views, as I said, is if we saw signs of a recession in the data, but most of the data points to continued growth. Moving on to the third of our big three, the bond market. Well, the Fed raised rates again in September. This is the third time this year, and they've given some signals they're going to raise rates again in December. And there's a lot going on in this picture, but this is so-called Fed dot plot. So what they do here is they ask the voting members on the Fed Board of Governors, what do you think interest rates are going to be for the remainder of 2018, and then looking out 2019, 20, 21. Now, excuse me, I doubt they have a very long-term crystal ball, but what this suggests is that rates are going to probably go up to 2.25% to 2.5% by the end of December. And then the consensus forecast is they're going to raise rates again another 3 times on average. So you might see rates go from 2.25%, 2.5% to close to 3.5%. And then they're predicting rates to rise again before they kind of stable off. So I guess the way to think of it is that rates are expected to continue to go up. From a fixed income strategy standpoint, this prefers us, or this suggests that we prefer short-term maturity bonds or those that have a floating rate coupon. You probably don't want to go in a 30-year treasury at this point, whether it's U.S. treasuries or you need bonds or corporate bonds. One thing that's been driving the rise in interest rates, despite the Fed raising rates at the short-term level, is the Fed is still continuing to shrink its balance sheet. You may have seen this graph before if you dialed into some of our other calls. This is called quantitative easing. So when the markets fell apart with the Great Recession, the Fed pumped money in not once, but twice, but 3 times. So each time they injected money into the system, it's called quantitative easing. And at the end of 2017, the balance sheet stood at $4.5 trillion. Well, the Fed has stopped reinvesting some of the proceeds, and they're gradually shrinking the balance sheet by about $50 billion a month. It sounds like a lot of money, but when your balance sheet's $4.5 trillion, I would describe it as a modest tightening. And it's a big unknown how they're fully going to unwind this. So we know what their plan is, but we don't know how it's never been done on this scale before. So this does create a risk of a rise in interest rates, an aggressive rise, and that might choke off the recovery. So to kind of summarize our bond market outlook, we do expect yields to continue to rise. We do expect that in an improving economy and an environment where the Fed is raising interest rates. We have tweaked our outlook for, instead of 3 or more increases, we think 4 is likely. Looking at some online calculators in the futures markets, there's an 80% probability that the Fed raises interest rates in December. But in our view, the Fed is not going to raise it too aggressively because it does not want to create an inverted yield curve. An inverted yield curve is when the short-term interest rate is higher than long-term rates. That's typically bad for bank profits. They stop lending, and that could result in a recession. In terms of our 10-year benchmark U.S. Treasury note, we've upgraded our range a little bit. So currently, it's around 3.15%. We think the odds are that the 10-year gradually tilts upward. So our new range is 3 on the lower end and 3.75% on the upper end. So if you're a bond investor in a plain vanilla Barclays Ag type bond fund or related strategy, we think at best you're going to get flat to very low single-digit returns. You might do a little bit better in short-term treasury bill type investments, floating rate notes. And as I alluded to before, we have some income-oriented strategies, real estate and infrastructure, even though they take on a little bit more than traditional fixed income rate risk. But we view those as portfolio diversifiers. Now, there are always risks. As I alluded to, I think the geopolitical risk is more heightened than any time since, I guess, North Korea firing off those missiles a little over a year ago. So there's a risk of a trade war with China. As you know, the U.S. placed a 10% tariff on many Chinese imports, and that tariff is scheduled to go up to 25% on January 1st. So that would also, if it goes down that road, it could be bad news for the equity markets. Fortunately, there is a planned economic summit at the G20 meeting in Brazil with President Xi of China and President Trump of the U.S. So hopefully they'll at least make some progress, agree to cooperate, and I think the markets would respond positively to that. There's still some trade tensions with Europe, even though it doesn't get the headlines. And fortunately, we have appeared to solve our trade dispute with both Mexico and Canada. Another risk is the rising U.S. federal budget deficit. Last fiscal year, which ended September 30th, it was about $750 billion. This fiscal year, it's scheduled to be between $900 billion and $1 trillion. So these are real numbers. It winds up pushing up interest rates because when the government is in the market looking for money, well, you need money to be able to absorb all that debt. So the only way is that if interest rates go up enough, it entices other investors into the market. Long term, we can't keep running these deficits forever, or else there may be some risk to the entitlement programs, whether that's Medicare, Medicaid, Social Security. So let's hope we get either growth accelerating or spending under control. Another shift that we've seen early in October is a shift in investor sentiment. They might say, well, stocks are getting risky. I'm happy getting 2.5% in my bank CD or treasury bill. So a wave of moving money from equities to cash could impact the markets as well. Other risks, we're seeing more and more store bankruptcies. You probably saw the slightly sad news of Sears declaring Chapter 11 bankruptcy. I remember as a kid ordering things from the Sears catalog. Well, unlike Toys R Us, which also went bankrupt and has appeared to shutter all of its U.S. stores, Sears is attempting to do a Chapter 11 reorganization. But Sears hasn't been the same for the past 20, 30 years. First, they were beaten by Walmart, and lately by Amazon. Another risk that I alluded to is a standoff between Italy and the European Commission. To be a member of the European Commission, you have to keep your budget deficit within a certain area. Generally, it's less than 1%, while Italy, it's approaching 3% of GDP. Because Italy is much larger than Greece, I think it would pose a much bigger problem to the European and by extension world economy if it were to unravel, or the risk of contagion is higher. That's how I would describe it. We now have the acknowledged murder, tragically, of a Saudi journalist, and that certainly has set any Mideast peace plans back, as well as creating the whole energy market, putting that back in turmoil. So we'll see how it shakes out, but they had a high-profile investment conference that most of the well-known executives and even Treasury Secretary Mnuchin have canceled their plans for that. So Saudi Arabia was once viewed as a very stable country for the U.S., at least a partner, and now let's describe that as being up in the air a little bit. Fortunately, things have gone in the right direction with North Korea. You may have heard that President Trump said that his letters were almost like a love letter with Korean dictator/president Kim Jong-un. But anything that reduces nuclear risk, we will be happy for. So that appears to be at least one thing going in the right direction. In terms of portfolio changes, as I alluded to, we made no formal changes in our open architecture platform. Those that have individual equities, of course, there are always periodic changes. Overall, on balance, the portfolios, I think, have provided attractive risk-adjusted returns. So we don't appear to make any changes, at least for this quarter. As we approach year end, you'll receive our thoughts on our views for 2019. As usual, we'll wind up with our rough portfolio guides. These guides are custom tailored to your unique goals and objectives. Our conservative portfolio, you'll notice there is a reasonable amount of short-term cash, a sizable amount of fixed income. As I alluded to, that's focused on those with a short-term maturity. We have some alternatives that would include, for example, some of the infrastructure funds I alluded to. We have some long-short fixed income funds. Hybrid is something that has the characteristics of both stocks and bonds, or has some downside protection. So our planned return strategy would fit in there. Some people might put our real estate investments there. And equity, of course, are our stock-oriented investments, whether it's Harding Loevner, Accelerated Return, some of the Vanguard funds, and so forth. Moving on to the moderate portfolio, you can see that the short-term or cash segment has disappeared. You can see fixed income has shrunk from 27% to 17%, and the equity allocation has increased from 23% to 48%. Lastly, our aggressive portfolio, for those clients that don't have a short-term need for income, that is the bulk of its equity. We have 10% in alternatives, 16% in hybrids, and notice no short-term or fixed income, because we believe at best you're going to get very low single-digit returns from that. Why they're there in the other portfolios is they provide diversification, stability, and less losses, and perhaps no losses in the event of strong down markets like we're seeing in October. So that's our recap for Q3. It was a very solid Q3. We're hoping that Q4 bounces back. At least by measures that I'm looking at, it's going to be a pretty solid holiday season. The market typically rallies from around Thanksgiving through January, so let's hope that pattern repeats itself. Other than that, I hope I'll see you at one of our holiday events or the economic event, and have a great day, and hopefully we'll see you soon.